So we are officially kicking off 2026. And it seems like the UK housing market is kind of like a car engine on a cold morning.
That's a good way of putting it.
It really sputtered at the end of last year. Prices actually dropped 0.4% in December.
They did.
But January saw the engine finally catch. Prices ticked up, what, 0.3%? It's not a roar, but it's definitely running.
It is running, and that change in sound, that's what we need to get into today. We're looking at data from nationwide, from a few property experts.
Right.
But the real story isn't just that prices rose a little, it's the mechanics underneath it all. We're talking about affordability.
And that's the key, because it looks like the math is finally shifting in a way that actually, well, supports buyers for the first time in a while.
For the first time in years, really.
That makes a lot of sense because late 2025 felt so hesitant. The average home price was sitting around $270,873, but it felt like no one wanted to move.
Everyone was just waiting,
Yeah.
paralyzed.
Yeah, waiting to see what the budget would do to property taxes. That political uncertainty was huge.
It was the primary handbrake on the market. Robert Gardner at Nationwide pretty much said that dip was almost all down to that uncertainty.
But now the drivers have changed.
Yeah.
The shock's worn off, and we're back to fundamentals.
Exactly. Back to what's in your wallet versus what's on the price tag.
And here's the part that's a bit surprising. Usually you see prices go up and you think, okay, things are getting harder to buy. But the data's suggesting affordability is actually improving despite that little price tick. I'm guessing this comes down to wages finally catching up.
Precisely. It's that real wage growth. Your pay is going up faster than inflation, and that's colliding with mortgage rates that have, stabilized.
They aren't rock bottom.
No, not at all, but they aren't so volatile anymore.
Okay, so let's get into the 32% rule because this is the metric that really matters to someone's bank account.
This is the number.
For a typical first-time buyer, 20% deposit, they're now spending 32% of their take-home pay on their mortgage, losing a third of your paycheck. That still sounds pretty painful.
It does, and you're right to be skeptical. If you look at the long-run average, say over 15 years, we're still a bit above the 30% norm.
So it is still historically expensive.
Yes, but you have to compare it to the immediate past. In 2023, that number hit a suffocating 38%.
Whoa. Okay, that puts it in perspective. Dropping from 38% to 32% is massive.
It's huge.
That 6% difference. It's like a tax-free pay rise for a buyer, isn't it?
Yeah.
In the real world, that's the difference between being forced into a tiny flat or actually affording a proper house.
Exactly right. That's why confidence is coming back. But, and this is a big but, we have to apply a serious caveat here.
It's never simple.
Property is intensely local. That national math works. But if you try and apply that 32% rule in the south of England, the logic just falls apart.
Right, I saw that regional breakdown. The South is still straining affordability, and Northern Ireland is actually seeing things go the other way.
It's getting worse there. Prices are surging so fast that affordability is deteriorating.
But then you have the opposite in the North. If you're in Yorkshire, the Humber, or Scotland, mortgage payments are actually trending slightly below their long-run averages.
That's right. Strictly speaking, those markets are almost cheap right now compared to their own history.
So it's a very fragmented recovery. Looking ahead then, experts like Alice Hain and Ian McKenzie are using words like healthier, momentum.
It feels like stabilization.
And that's largely because supply is increasing. There are just more homes to choose from.
Which keeps a lid on price wars. But there is a trap waiting in the economic data. Tom Bill from Knight Frank pointed this out. It's about the Bank of England.
The classic good news is bad news scenario.
Exactly. The economy is performing a little too well.
Which I always find so annoying. So because the economy is strong, inflation risks stick around, and the Bank of England keeps interest rates higher for longer.
That's the mechanism. A booming economy is a nuisance if you're waiting for a cheaper mortgage. The market had priced in some aggressive rate cuts for this year.
But that's looking less likely now.
The theory of two big rate cuts is fading fast. We might just be stuck with these rates for a while.
So the takeaway is, we have a functional market, but not a cheap one. We have momentum, but there's a ceiling on how much help we're going to get from rates.
It's a return to normality, which is, a bit boring, but it's functional.
That brings me to a final thought for you. For years, we've all been conditioned to chase capital growth. Buy a house, watch the price explode. But with prices stabilizing and boring becoming the new normal, do you need to rethink your strategy? If that capital explosion isn't coming, maybe you should be looking at yield instead of growth. Something to chew on. Thanks for listening to this deep dive. We'll see you next time.